Hello, I'm Rudy Hollebrook, broker and owner of Real Property Management LoneStar. This is our 2025 rental market update for Austin, Dallas, and San Antonio, and more importantly, what those trends mean for pricing and performance as we head into 2026. Let's start with the first major shift we saw in 2025. Rent growth normalized, it did not collapse. After the post-pandemic surge, rent growth across Texas single-family rentals slowed and stabilized. This was not a sign of weakening demand. It was a transition back to more balanced and sustainable pricing environment. What changed in 2025 is how pricing power works. Supply growth and affordability constraints now play a much larger role in determining rent outcomes. Instead of automatic rent increases, pricing precision matters more than peak asking rent. Speed to lease and vacancy control now have a greater impact on annual income than holding inflexible pricing targets. The shift set the tone for the entire year. And as we will show in the next slides, it explains why vacancy and days on market became the most important performance drivers in 2025. Before we talk about rent growth, it's important to anchor on absolute rent levels. This slide shows the average rent for single-family homes across our Texas markets. What stands out here is that rent levels remain historically elevated. Even after normalization, rents are well above pre-pandemic baselines. For most owners, this means the income foundation is still strong. The question in 2025 was not whether rents collapsed, they didn't. It was how efficiently that income could be captured through pricing and execution. These average rent levels set the context for everything else we'll cover. In the next few slides, we'll look at how rent growth behaved in 2025 and why pricing accuracy mattered more than pushing for incremental increases. Now let's look at how rent growth actually behaved in 2025 across our three core markets. This chart compares two things: year-over-year change, which shows where rents stand versus the same time last year, December 2025 versus December 2024, and month-over-month movement, which captures the short-term pricing adjustments late in the year, December 2025 versus November 2025. The important takeaway here is balance. Across all three markets, we're not seeing collapse. We're seeing modest annual growth paired with tactical short-term repricing. In other words, rents remained relatively stable on a yearly basis, but owners and managers had to stay responsive month to month. This reflects a market where demand is still present, but pricing precision matters more than momentum. Each market expressed this a little bit differently. So next, we'll break this down market by market, starting with Austin, to explain what these patterns meant in practice for our owners on the ground. So let's start with Austin. Austin showed positive year-over-year rent growth in 2025, which confirms overall pricing stability. This tells us demand is still there and the market did not roll over. At the same time, we saw some short-term softness later in the year. That month-over-month dip was not a demand issue. It reflected seasonal patterns and tactical repricing. What's important is how the market responded. Well-priced homes continue to lease efficiently, which signals that Austin is operating near equilibrium. This is a different market than the growth-driven years. Austin had shifted from momentum pricing to precision pricing. Owners who stayed aligned with the market rent and prioritized speed to lease protected income and avoided unnecessary vacancy. That dynamic becomes even more pronounced as we move into the next market. Now let's look at Dallas. On an annual basis, rent growth in Dallas remained positive in 2025. That confirms rents are still above prior year levels, even after recent pricing adjustments. Where Dallas differs is in the short term. We saw more pronounced month-over-month repricing late in the year. This was not a demand shock. It was an active market correction driven by elevated supply and affordability constraints. As a result, leasing velocity became the deciding factor. Homes priced accurately to the market absorbed faster, reducing income leakage and limiting vacancy drag. The takeaway for Dallas is clear. The market is mid-reset, transitioning from post-pandemic pricing highs to a more competitive environment. Owners who adjusted early, priced to market, and prioritized speed to lease were the best positioned to protect their cash flow and outperform as conditions normalize in 2026. Now let's turn to San Antonio. San Antonio followed a slightly different path in 2025. On an annual basis, rents remained modestly below prior year levels. This reflects a slower post-pandemic reset compared to Austin and Dallas. What's important, though, is what happened more recently. We began to see positive month-over-month movement late in the year, which signals early stabilization and improving pricing traction. As conditions normalized, competitively priced homes started to lease more efficiently. That improvement in absorption is an early indicator that momentum is beginning to rebuild in San Antonio. The takeaway is this: the market appears to be in early stages of recovery. While annual growth has not fully turned positive yet, owners who price realistically, stay responsive to market feedback, and prioritize speed to lease are well positioned to capture early upside as conditions continue to be firm in 2026. Up to this point, we've talked about rent levels and rent growth. Now we need to shift our focus to what actually drove performance in 2025. In a normalized rent environment, vacancy risk overtook rent growth as a primary driver of owner outcomes. When rents are not accelerating, the time vacant has a much larger impact on annual income than incremental rent increases. In 2025, days on market became the leading indicator. Homes that lingered on the market were almost always signaling pricing friction. Homes priced accurately to market leased faster and protected cash flow. This is where execution began to matter more than aspiration. Accurate pricing, responsive adjustments, and professional marketing separated outperforming owners from those who absorbed unnecessary vacancy. As we will show next, speed to lease became the most controllable lever owners had in 2025, and it will remain critical going into 2026. By 2025, days on market became the market's verdict on pricing. In a normalized rent environment, the market responds quickly. Homes that are priced correctly receive activity early and lease efficiently. Homes that sit on the market are almost always signaling pricing friction. This isn't about property quality alone, it's about price. Condition, layout, and location matter, but pricing is the fastest feedback loop that we can get. The longer a home lingers, the clearer the message from the market becomes. What we saw in 2025 is that days on the market mattered more than small rent differences. A few extra weeks of vacancy often erase the benefit of a higher asking rent many times over. The takeaway here is simple. Pricing accuracy reduces vacancy risk far more effectively than pushing for incremental rent increases. Speed to lease isn't just a leasing metric anymore, it's a financial performance metric. As we look ahead to 2026, one theme becomes very clear. The market will reward strategy, not inflexible pricing. The environment we're entering is different from the post-pandemic years, and supply and demand are rebalancing, and outcomes are increasingly determined by how quickly owners respond to market signals. In this type of market, waiting for conditions to improve on their own carries real opportunity costs. Every extra week of vacancy directly impacts annual returns and takes time to recover. What consistently outperformed in 2025 was disciplined execution. Accurate initial pricing, strong presentation, professional marketing, and timely adjustments protected cash flow and reduced vacancy drag. As we will show next, data-driven pricing decisions don't mean giving up rent. They mean protecting income and positioning properties to outperform as we move further into 2026. Let's look at a real example from San Antonio. This was a single-family home listed in mid-November of 2025. It's a 4-bedroom, 2.5-bath home, just over 2,000 square feet. The home was listed at $2,200. Within 3 weeks, it generated multiple inquiries, received an application, and residents moved in early December. This wasn't about underpricing the property, it was about positioning the home correctly from the start, so it could lease effectively without extended vacancy. This example sets the foundation. Next, we'll walk you through how that rent was actually determined by our systems. Now let's look at the numbers. Owners often focus on the monthly difference and an extra $100 in rent. What's easy to overlook is the income impact of a vacancy created by that higher price. In this scenario, a market-aligned rent of $2,200 leased in about 3 weeks. At $2,200, the rent premium works out to be roughly $23 per week. That means just one additional week of vacancy takes about 22 weeks to recover. Each extra week vacant extends their recovery period even further. This is why pricing decisions compound so quickly. Protecting speed to lease is far more valuable than chasing a small monthly premium. This is where the pattern becomes very clear. For every 2 additional weeks of vacancy, the recovery time increases by roughly 44 weeks. In other words, small delays up front create very large recovery periods on the back end. At that point, pricing decisions stop being about rent optimization. They become long-term income recovery decisions. This is why, in today's market, protecting speed to lease is one of the most important financial levers an owner has. As this line continues beyond 6 weeks, what matters most is the direction, not any single data point. Each additional week of vacancy adds a disproportionate amount of recovery time. The slope stays steep. That means recovery does not extend, it compounds. By the time vacancy reaches the higher end of this range, the recovery timeline has expanded dramatically relative to the original pricing decision. The takeaway here is about trajectory. Once vacancy begins to stretch, every extra week makes the math harder to undo. And that's why pricing discipline early in the leasing process has an outsized impact on long-term performance. Now, let's state the conclusion clearly. When a pricing decision delays leasing by 6 weeks, the recovery period is roughly 132 weeks. This is about 2.5 years. That's not an edge case, that's the math of vacancy in a normalized rent environment. At that point, the decision is no longer about optimizing the rent, it's about managing long-term income recovery and cash flow drag. This is why in 2025, and especially heading into 2026, protecting speed to lease consistently outperforms inflexible pricing. That shift defines what worked in 2025, and it's the mindset that will separate outcomes going forward. We'll close with a quick note on methodology. The data you've seen here comes from multiple independent sources. That includes RPM LoneStar's internal leasing and vacancy data across Austin, Dallas, and San Antonio, along with AppFolio portfolio reporting, MLS rental comps, and the Zillow Observed Trend Index. The goal isn't to rely on any single data point, it's to look for consistent signals across multiple sources and apply them to real leasing decisions. So what does all this mean for your property? First, pricing above market often costs more in lost rent than it ever earns back. Second, early pricing adjustments reduce vacancy drag and shorten long recovery periods. And third, data-driven pricing protects long-term cash flow and asset value. Every property is different. That's why we're always happy to walk you through the numbers for your specific home and help you make informed decisions.